Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Right now we're looking at Europe's economy, and it's basically being brought to its knees.
Yeah, and not by a sudden market crash or like a trade war, right?
Right, not a cyber attack either. It's actually the mud at the bottom of their four biggest rivers.
It is a really stunning geographical shift happening in real time. According to a mid-August 2026 report from the Joint Research Center, the Loire, the Po, the Rhine, and the Danube rivers are all simultaneously hitting record low water levels.
Wow, all four at once.
Exactly. The foundational geography of an entire continent is essentially, changing its behavior overnight.
And for you listening right now, you might be asking why we're focusing on European rivers today. I mean, here in the U.S., especially under President Trump, there's a massive focus on domestic manufacturing, right?
And securing our own supply chains.
Yeah, exactly. And fighting inflation right here at home. But looking at what is happening in Europe right now provides an absolute masterclass in just how fragile international supply chains really are.
It really does. Because even if your portfolio in your business are focused entirely on the American economy, well, the lessons from this crisis show us exactly what happens when the hidden, the invisible pillars of global industry just start to wobble.
So what's the actual mission for our deep dive today?
Well, the data we're looking at makes one thing abundantly clear. This is not simply a passing weather story about a hot summer. What we are witnessing is a massive correlated supply shock.
A correlated supply shock.
Right, it's a giant continent-wide bottleneck. The lack of water is simultaneously paralyzing European shipping, unplugging their power grids, and, well, devastating their agriculture all at once.
Okay, let's unpack this, because we need to explore the mechanics of how a lack of water manages to do all of that.
Yeah, let's start with the physical movement of goods, right? The arteries of the European economy.
Right, the shipping lanes.
Exactly. According to recent analysis, the Rhine River is the absolute lifeblood for Germany's industrial machine. That's how they transport chemicals, coal, steel, the incredibly heavy materials that build everything else.
But as of mid-August, water levels hit such record lows that a massive portion of freight is being forced off the water entirely.
Yeah, and to an American listener, a river getting a little low might just mean pulling the fishing boat in early.
Right, it doesn't sound apocalyptic. But imagine if Interstate 95 or the Mississippi River suddenly had a strict, severe weight limit overnight. The highway isn't technically closed with a barricade, but suddenly commercial 18-wheelers can only carry a tiny fraction of their usual cargo.
What's fascinating here is that the underlying math of logistics completely breaks down in that scenario.
How so?
Well, when the Rhine drops to these critical levels, the barges can still technically navigate the channel. But to avoid physically scraping the bottom...
Right, nobody wants to ground a massive vessel.
Exactly. So to avoid grounding the vessel, they have to dramatically reduce the weight they're carrying. A lighter boat sits higher in the water.
Oh, so they just load less stuff.
Right. Sometimes they're running at just 25% capacity. So if a German chemical plant needs, say, 1,000 tons of raw materials just to run its daily operations, they can't just hire one barge anymore.
They suddenly have to hire 4 barges just to move the exact same amount of material.
Exactly. Which means the demand for barges skyrockets overnight.
And there simply aren't enough physical boats on the river to handle that kind of multiplier.
No, there aren't. And when you run out of barges, well, companies panic and pivot to the railways.
But European railways have to be pretty full already, right?
Oh, absolutely. They're already operating at or near maximum capacity with passenger and standard freight traffic. You can't just spawn new train cars out of thin air.
So what happens when the rail option is exhausted?
You pivot to trucks. And this is where the unit economics become an absolute nightmare.
Because it takes a lot of trucks to replace a barge.
Hundreds. It takes hundreds of standard commercial trucks to move the cargo of a single, fully loaded river barge. You need hundreds of drivers, exponentially more diesel fuel, and vastly more time to navigate road traffic.
So the sudden spike in the cost per ton of cargo has to be staggering.
It really is. It's a massive hidden tax on everything that moves.
And that injected cost goes straight into the heart of manufacturing, right? It just eats up corporate profit margins before a product is even built.
Exactly. It acts as direct, unavoidable inflation. It's not about the river being closed, It's about the basic unit economics of transport collapsing. You are paying 4, 5, or 6 times the usual freight rate just to keep your factory doors open.
So we've established that factories are bleeding money because they can't get the raw materials they need efficiently.
Right.
But reading the data, it seems like even if those materials did arrive, the factories wouldn't be able to turn on the machines to process them anyway.
Yeah, that's the second major issue. These dry rivers are actively unplugging Europe's power grid.
Right, moving from the Rhine over to the Danube River, the research details this wild situation in Romania at their Cernavoda nuclear power plant.
It's unbelievable.
Hmm.
Because the Danube's water levels dropped so low, Romania had to completely shut down both of its nuclear reactors.
And they didn't just quietly flip a switch, did they?
No, they didn't. Romanian authorities literally called in the Navy to blow up rocks in the riverbed with explosives.
Wait, actual explosives?
Yes, explosives. They were dredging the channel, desperately trying to force whatever water was left toward the plant's intake pipes.
That is insane. I mean, the sheer desperation of using naval explosives to alter a riverbed tells you everything you need to know about how critical this infrastructure is.
Absolutely. And here's the kicker. Even with those controlled detonations deepening the channel, they still couldn't secure enough water flow.
So they just lost that power generation entirely.
Completely lost it.
Yeah.
But looking at the data, it's not just Romania resorting to extreme measures.
Right, I saw the notes on Hungary. Utility operators there needed to keep their PAX nuclear plant running.
Yeah. And to do it, they intentionally sank 2 80-meter-long barges right into the Danube River.
That's massive. They basically sacrificed giant ships to create an artificial underwater funnel.
Exactly. They were aiming to raise the water level just enough around the plant's intake valves. And even with that drastic step, the plant is running at barely a quarter of its normal capacity.
Wow. Which brings us to France, where the situation is arguably even more structurally alarming. The Loire riverbed is physically exposed to the air in several sections.
Yeah, you can just walk on it. Because of this, France lost 9.4 gigawatts of nuclear power production over the summer.
Wait, let me translate that for you listening, because gigawatts can sound like abstract sci-fi jargon. 9.4 gigawatts is roughly the equivalent power needed to run 10 million average homes.
That is a massive chunk of power.
Yeah, that amount of electricity just vanished from the grid. And the data shows that day-ahead power prices jumped 4.4% to over 154 euros per megawatt hour in a single day.
Right, which is a huge spike.
Can you explain what a day-ahead price actually is? Like, why is a 4% jump such a big deal?
Well, day-ahead prices are essentially the panic barometer of the energy market. Utilities buy and sell power for the very next day, based on expected demand and supply.
Okay, so like booking a last-minute flight for tomorrow morning.
Perfect analogy. If seats are suddenly scarce, the price skyrockets. When 9.4 gigawatts drop off the grid unexpectedly, utilities have to scramble onto the open market to buy replacement power at exorbitant last-minute premiums.
Just to keep the lights on for their citizens.
Exactly. So that 4.4% daily jump represents millions of dollars of unexpected costs hitting the system in a matter of hours.
No, I have to push back on something here, because this goes against how I've always understood energy.
Okay, what's that?
Well, I always thought of solar and wind as the vulnerable, weather-dependent power sources.
Yeah.
You know, the sun goes behind a cloud or the wind stops and you lose power.
Right, that's the common perception.
But I've always viewed nuclear energy as the bulletproof, steady baseline that runs no matter what the sky is doing.
This raises an important question, right? Because it is a very common misconception. We think of nuclear as this isolated, high-tech fortress.
Exactly.
But at its core, a nuclear power plant is just a highly advanced, incredibly hot way to boil water. The nuclear reaction creates heat. That heat boils water into steam, and the steam turns a massive turbine to generate electricity.
Okay, making sense so far.
But once that steam has done its job, you have to cool it back down into liquid water so the cycle can repeat. That cooling process requires a massive continuous flow of cold water.
Which is precisely why these plants are built right on the banks of major rivers.
You got it.
Let me make sure I'm wrapping my head around this. It's kind of like a car engine overheating on the highway. It's not just that the radiator's out of coolant. The coolant you do have, the river water, is boiling hot to begin with because of the summer heat wave.
You've hit on the core thermodynamic problem. The issue here isn't a failure of nuclear technology itself. The issue is the specific cooling architecture of these older plants.
So they weren't built for this kind of heat.
Exactly. They were designed decades ago, built for climate and weather models that simply do not exist anymore. In France, some plants actually have enough water volume, but the river itself is already so warm from the ambient heat.
Right.
So if they pump it into the plant, use it to cool the reactor, and dump it back into the river, the discharged water would be literally hot enough to boil the local ecosystem.
Oh, wow. So strict environmental regulations force the operators to power down the reactors just to protect the fish and the river biology.
Exactly, which means utility operators are being forced to throttle back electricity production at the exact moment when millions of people are cranking up their air conditioning to survive a heat wave.
That is a terrible combination.
And it completely upends the traditional utility business model. Historically, the ultimate stress test for the European power grid was the dead of winter.
Making sure everyone had enough heat to survive January.
Right. Utilities built their entire financial models around winter peaks. But now, because of these river constraints and soaring summer temperatures, summer power prices are actively rivaling winter peak prices.
So the entire seasonal model of energy economics is being flipped upside down.
Yes, forcing a massive structural shift in how power is priced and distributed.
That is terrifying for anyone trying to run a manufacturing business or even just balance a household budget. So the arteries are clogged on the Rhine, spiking transport costs. The engine is overheating on the Danube and the Loire, shutting down the power grid.
Right.
Let's move to the third shockwave. How does this affect the literal fuel for the human workforce? Our food.
Yeah, this takes us to the Po River in Italy.
Right. According to the data, the Po River Basin, which produces over 80% of Italy's rice, is just drying up into cracked mud.
It's really bad. Farmers in the Pavia region are facing 100 million euros in direct losses. They're being forced to play God with their crops, deliberately sacrificing entire fields to funnel whatever trickles of water are left to try and save others.
Meanwhile, in France, corn production is expected to plunge 35% to under 7 million tons. That marks the worst harvest since 1976.
Yeah, the numbers are grim.
Now, for you, the American listener pushing a cart through a grocery store in Texas or Ohio, you might be thinking, I don't live in Italy. I don't buy French corn. Why does this matter to my wallet?
Here's where it gets really interesting. It matters because the global agricultural market is deeply interconnected, and the consequences operate on what economists call a lag effect.
Okay, explain that lag effect, because if I go to the store today, the price of corn hasn't changed.
Right, so think of the lag effect, like a massive traffic jam on the highway. The accident happens miles ahead of you, but you don't feel the brake lights for another hour.
Oh, I hate when it happens.
We all do. In agriculture, the prices at your local grocery store don't spike the day the river dries up. There are massive grain silos, regional inventories, and national reserves that cushion the initial blow.
So food companies use those reserves to keep prices stable in the short term.
Exactly. But here is the mechanism. When Europe loses 35% of its corn harvest, millions of tons of food simply vanish from their domestic supply. To feed their populations, European nations are forced to go onto the global open market to buy replacement corn.
And when they step onto the global market, they are suddenly bidding against American buyers, Asian buyers, everyone else.
Correct. They inject massive new demand into the global system. That drives up the baseline price of commodities everywhere, including the corn grown in Iowa.
And this is where it hits the American consumer's wallet.
Yes. Because most commercial corn isn't eaten by humans on the cob, it is used as livestock feed.
Right. Corn feeds cows, pigs, and chickens.
Exactly. When the global price of feed goes up because of a drought in France, it costs the American farmer more to raise their livestock. That increased cost is passed down the supply chain.
So months down the line, long after the summer heat wave has ended, it shows up as a price hike on your steak, your milk, and your bacon.
It's a delayed reaction, but the math guarantees it will eventually hit the consumer's receipt.
Wow. And diving deeper into the analysis on the Po River, there's a fascinating detail about where this water actually comes from, because the Po doesn't just rely on a few thunderstorms in July, right?
No, not at all. It relies heavily on the alpine snowpack, glacial runoff, and deep water reserves in places like Lake Maggiore.
Okay.
If we connect this to the bigger picture, the snowpack in the Alps functions as a giant natural battery for the entire region's hydrology.
Wait, I want to make sure I understand that analogy. By battery, you mean the winter snow is basically frozen water storage, and as it slowly melts over the spring and summer, it continuously recharges the river.
That is the exact mechanism. And right now, that natural battery is completely depleted. The winter didn't produce enough snow, meaning the storage was empty before the year even began.
So they started from behind.
Right. Then the spring rains failed to compensate, and finally the summer heat broke the already fragile system.
So this proves that what we're seeing isn't just the result of a single hot week in August.
Exactly. It is a compounding, structural, year-round water storage failure. When the vast, deep reservoirs that are supposed to act as the ultimate buffer run completely dry, it signals a long-term capital problem, not a short-term weather anomaly.
So what does this all mean? We have the barges stuck in the mud, the nuclear plants starved of cooling water, and the agricultural yield plunging. Let's bring all three of these shocks, shipping, energy, and food together into one big macroeconomic picture.
It's a perfect storm.
Yeah, for the beginner looking at this, let me try an analogy. Imagine your boss suddenly cuts your paycheck by 20%. You're making less money. But in that exact same week, your grocery bill and your utility bill both double.
Ouch.
Right. You have significantly less money coming in, but everything costs twice as much to maintain your standard of living. Am I right in thinking that is essentially what is happening to the entire European economy right now?
That is a perfect translation of a concept known as stagflation. And stagflation is the absolute worst-case scenario. It's the ultimate nightmare for central bankers.
Let's break down that word.
Sure. It is a combination of economic stagnation, low growth, where factories aren't producing and paychecks aren't growing, combined with high inflation, where the cost of everyday goods is soaring.
Because traditionally, inflation usually happens when the economy is red hot, right? People have lots of extra cash, they rush out to buy a lot of goods, demand outpaces supply, and prices go up.
In a normal environment, yes. And a central bank, like the European Central Bank or the U.S. Federal Reserve, has tools to deal with that. Think of interest rates as the pedals in a car.
Okay.
If the economy is running too hot and inflation is high, the central bank hits the brake pedal by raising interest rates. This makes borrowing money more expensive, which cools down consumer spending and lowers prices.
And conversely, if the economy is stalling out and growth is low, they hit the accelerator pedal by lowering interest rates. Cheaper borrowing stimulates businesses to build and hire.
Exactly. But the European Central Bank is currently sitting in a car that is both stalling out and overheating at the same time.
Oh, so they are completely trapped.
Completely. They have a struggling, stagnant economy because factories physically cannot get parts off the dry rivers, and power is too expensive to run the machines.
So the ECB desperately wants to lower interest rates to throw a lifeline to those struggling businesses.
But they can't. Because if they lower rates and pump more money into the system, they risk supercharging the inflation that is already skyrocketing due to the supply shock of expensive food and energy.
Wow. This correlated supply shock effectively removes the central bank's primary policy tools.
Because they can't print water.
Right.
No amount of interest rate tweaking puts water back in the Rhine.
That is a chilling thought.
Which brings us to the ultimate investment insight derived from all of this recent analysis. For the last century, the global industrial model has operated on a quiet, underlying assumption.
What's that?
That fresh water is a free, unlimited, guaranteed resource. It was just a negligible line item on a corporate balance sheet that nobody worried about.
You build the factory next to the river, stick an intake pipe in the water, and you assume it will flow forever.
Right. But that era is definitively over. Water is no longer a free utility. It is now a highly strategic, premium capital asset.
So moving forward, massive industrial companies are going to have to spend extraordinary amounts of capital expenditure CapEx just to secure their basic water supply.
Exactly. We are talking about billions of dollars that must now be diverted to build advanced, closed-loop cooling towers that recycle water.
Or massive desalination or purification facilities.
Right, or new cross-border transmission lines to share power when one region goes dry, and giant battery storage systems to capture renewable energy for when the rivers can't provide baseline nuclear power.
So the baseline cost of doing business, the barrier to entry for heavy industry, has permanently increased.
Yes, and as a result, the way we analyze markets has to evolve. Investors, economists, and even everyday observers need to start watching river levels not as neat bits of nature trivia on the evening news, but as high-frequency leading indicators for industrial output.
Meaning, if you look at a gauge and see the water level drop in the Rhine in July, you can confidently predict an earnings miss for a major chemical manufacturing company in October.
Exactly. Geography is now an active, volatile variable on the corporate balance sheet.
Which completely changes how you calculate the true value of a company. If you are investing in a company that hasn't accounted for its water vulnerability, well, you're flying blind. And that leaves us with a fascinating and maybe slightly unsettling thought for you to mull over as we wrap up. If the entire foundation of the modern global economy, from the steel in our buildings to the food in our pantries, was built on the quiet assumption that water is free and infinite,
Yeah.
what happens to the valuations of massive companies worldwide when they suddenly have to start paying for it as a premium, heavily constrained resource?
It's a massive foundational shift, and it's happening right in front of us.
Definitely something to think about the next time you turn on your tap. Don't forget to subscribe and hit that like button.